Today, I will break down the numbers and the figures behind a deal flow pipeline so that you can get a better understanding of the type of output that you need to produce in order to generate a set amount of transactions. And I think this video can help really anybody that is looking to buy a business for the first time or maybe bought a business already, but even advisors that are looking to maybe sign new sales side client and they're looking to sign more of these engagements and then close a set amount of transactions per year. I think this video can help all of them because what I've seen in most instances is that a lot of them don't keep track of the numbers, and therefore they don't know what they need to be doing in order to generate the results that they want. So I spoke with a lot of advisors that maybe want to do 5, 10, 15 deals a year, but they don't know the type of work that they need to generate in order to get to that 10, 15 deals a year. To the same degree, I talked with roll-up companies that want to close 5 transactions a year, but they don't know how to get there. Same degree for search funds that may want to close a deal in 6 months or 9 months, but they don't know how to get there predictably. So I think breaking it down with numbers is the best way to go about that so that we can get a clear understanding of what you can expect, at least from a off-market origination standpoint. If you're working with brokers or your existing network, there might be other channels that help you find deals. But I think overall, you can take this example that I use for off-market deals and apply it to basically any channel that you're utilizing to source deals and close deals. The important part is understanding that M&A is a numbers game, as I will show you. And then once you understand that, build your system accordingly, and also your mental process, being kind of like aligned with the idea that this is going to be a numbers game. And again, I want to record this because I saw so many people being kind of like a bit delusional about it, to be fair. Even advisors that have been in the business for 10, 15 years don't have, kind of this type of visibility on the numbers they, have in their pipeline. And so it's important to have that kind of understanding. Otherwise, you will never know how you can improve the outcomes and how you can get to where you want to go. So I think as initial assumptions, I can share some facts. I mean, the first is we need to assume how many businesses that are currently available for sale, that might be available for sale, are actually going to be worth buying. That number can vary depending on the industry. Private equity groups generally say that 1 out of 50 or 1 out of 100 businesses is actually worth buying. That might be too stringent. I feel depending on the industry, we might be talking about 1 out of 10, 1 out of 25 businesses is actually worth acquiring, depending, of course, on your criteria, sector you're in, and all these sorts of variables that I don't have visibility on. So I'm using that as an initial assumption, so to speak. And again, you can adapt this if you want to make this case study a little bit more stringent. Feel free to do so. You can just adapt the figure and make it 1 out of 25, 1 out of 50, 1 out of 100, and play the math using these figures. Now, another thing that we need to consider is that about 80% of initiated transactions fall apart. And this is true basically in any sector. And so, it might not sound like a good piece of data because 4 out of 5 businesses that go under LOI or, proceed through the diligence don't actually close. But generally speaking, the deal that is going to go through out of these 5 is the one that ultimately is going to make the whole process worth it. So the return that you get out of one transaction closed pays back for all the failed ones. And that's kind of like the idea. Then there's also this idea, this concept of 30% of closed deals deliver the expected or exceed the expected ROI. So as a rule of thumb, we can say that 30% of deals that get closed lose money, 30% break even, and 30% make a lot of money. And generally speaking, what we would be looking at is, the 30% that makes a lot of money. Of course, a lot of things that go into that, one of which is your management capabilities and all these sorts of things, which is something that I have no control over, so I cannot put it into the numbers. But I think Those are kind of like decent assumptions based on you know, overall market data and insights. I mean, I might be a little bit too optimistic on the 1 out of 10 businesses that are for sale that is actually worth buying, but still, let's be optimistic here and maybe a little bit more stringent in the process of collecting deals. So if we take these assumptions as true, we can say that, you know, 1 out of 5 businesses is actually going to close independently of how many you get into your pipeline, right? So we need to get at least 5 good deals that match exactly your criteria in order to get to that one closed deal. If we follow this, you know, assumption and this model, right? Now, if we also say, okay, 1 out of 10 businesses that is currently selling is ultimately worth buying, it means that we need to look at a total of 50 businesses in order to get the 5s that are actually worth buying. And out of the 5s that are worth buying and that we move forward with in terms of LOIs and due diligence, only 1 is going to close. And so the idea here is like 50. If 1 out of 10 is worth buying, then in order for us to get 5, we need to look at 50 businesses, right? And this is just the initial assumption that we can make. And again, we can stretch it up as much as we want, but for this, for the purposes of this video, I'm just going to use these numbers. So we want to close 1 deal, and we need to look at initiate at least 5 transactions in order to get to that closed transaction. In order to initiate these 5 good deals, we need to look at least 50 transactions. Now, how can we accomplish that goal if we're sourcing deals off market? Well, there's a variety of ways we can do that. Multi-channel, single channel, multiple steps outreach, single step outreach, you name it. Let's just say that, for simplicity, we're just going to use 1 channel. And in this case, we say, okay, we're just going to do email outbound to business owners to find these 50 opportunities that we want. How many businesses do we need to contact in order to find 50 businesses that are actually interested in selling, right? Independently of whether these businesses might be good or bad. Well, I created this little tab here that is going to do the math for us. And this is assuming we have a reply rate for a cold email at 2%, out of which 50% of these replies are positive, and then out of them 50% book a call and 75% show up. That's kind of like the process, and I'm going to show you how it looks in practice, in a second. So let's say that we have a total pool of 5,000 companies that we want to reach out to. That gives us around 19 opportunities. So it's a bit too small. So let's try and increase that to let's say 12,000. Okay, we get to 45. So let's try and increase a little bit more. Let's try 3,500. Okay, 51. So in order for us to get 51 opportunities, if we only do cold email and email outreach to business owners, we will need to contact ideally 13,000 businesses. And again, this is assuming we're connecting with 13,000 businesses. 2% of them reply. So basically 270 businesses reply to us. Out of these 270 replies, 50% are positive. So we have 135 people that say, yes, I'm interested in selling the business. Then not all of them book a call, right? Because somebody, forgets about it, they get lost or they change their mind, whatever. So 50% book a call. We have 67 booked appointments. And with 75% of them showing up, we have 51 opportunities that actually show up and that entertain a conversation about selling the business because they have real motivation. Now, as I said, those are 50 opportunities that we don't know if they're good enough, right? As I said here, we are assuming that 1 out of 10 is worth buying. So we're going to be talking with 50 people, assuming that 5 of them, that we're having a conversation with are going to be good businesses that match our search criteria. They're good businesses. We want to acquire them. They have all the fundamentals in place, and therefore, by having five of them that go under LOI and then due diligence, we can expect one of them to close and therefore have one successful transaction. You might be asking, well, Marco, how did you pull these figures like the 2% reply rate, positive reply, and booking rate? We pulled them out of campaigns that we run in the past for clients. I guess the only we kept everything very very conservative. The only optimistic figure might be the positive reply rate, but that really depends on the list that you're using. So generally speaking, the more detailed the list is, the better the reply rate, and the better the positive responses. But of course, it depends on the market. You might have higher reply rate and a lower positive reply rates, and that will still do the trick. I guess these are just numbers that we're taking as an assumption that of course can vary but still deliver the desired outcome. So the point I'm getting at here is, okay, we need to contact, if we only use cold email, 13,000 businesses in order to get to this desired amount of companies. Now you might say, well, Marco, there are not 13,000 businesses in the vertical, in the geography, in the market that I'm targeting. And that's tough shit. I mean, to be fair, but that's why in most instances, I always recommend having a multi-channel approach, because despite the fact you might have a very small list of companies that you want to acquire, that you want to connect because you feel they're the good fits, if you just use one channel, you're basically putting all your eggs in one basket and hoping that channel will work. And if that is not the case, you're completely screwed. So you have no diversification, no options to leverage when it comes to sourcing deals. And that can prevent your ability to hit the desired outcome, let alone the fact that here we're talking about just closing one deal. If you're talking about closing more, maybe you're an advisor and you want to close one deal a quarter, or you are a roll-up company, you want to close one deal every 2 months, then this complicates things a lot more. Now you might say, well, yeah, I can follow up with these businesses continuously, and maybe some of them will become interested, 3-6 months down the line. That's true, but we cannot make that assumption from the get-go. And so we need to kind of like find the amount of opportunities that might ideally be available to us within that specific market based on the amount of companies that you currently have access to. Now, why do I say all this? Well, because as we said before, you might say, well, there are not 13,000 businesses in my industry. So if I just use email, and maybe let's say I have only 2,000 businesses that are a fit for what I want to do, I only got to get 8 opportunities running this funnel with the same numbers and so forth. So I'm completely screwed. I'm never going to get there. And even if I can contact these people over and over again, I might need to work on a process that is 6, 9, 12 months long, maybe even more than that, and not even get there. So how can we solve for that? Well, that's why I want to talk about the multi-channel approach that is actually a bit better in nature and ultimately enables us to mitigate some of the risks in the problems that are associated with M&A, which is, as I said, the numbers game, kind of like the problem that we need to look at a lot of deals before we actually find one that is worth closing. And so the idea here is this: assuming again these initial kind of like assumptions or thesis that we put out are true, how can we get to these 50 opportunities, 50 calls, whatever, even if we have a niche, even if we have a limited amount of companies that we can connect with? Well, the idea there is we can touch owners on multiple channels, because some of them might reply on another channel and they might be interested in selling their business, Simply, they weren't receptive to the message because you used the wrong channel to connect with them. And that's something that we saw being true across the board. It's like uh, people that would never reply to your email would then reply to a LinkedIn message, or people that would never reply to a cold call then reply to an email. So there's a lot of things that we can integrate into a deal origination system that enable us to get more deal flow using different channels in maybe the same amount of prospects, right? So we're not changing the amount of prospects. And as you can see here, I'm keeping the amount of prospects the same, assuming, let's say, we have just one list that we need to work with and we need to hit this one deal. So how can we do that? Or at least how can we increase our chances of getting that done? And kind of like do everything that we can to get to that finish line. Well, through a multi-channel outreach, we can basically roll the list into different channels and then see where the owners are more likely to respond. And so, following the example that I just gave you, if we keep the 2,000 businesses only via email, we will only get 8 calls with companies or motivated sellers in this case. On the flip side, if we add these 2,000 businesses into other campaigns, we might get new additional leads and therefore hit our goal. So in this case, I prepared the kind of like an example that I want to show you. So let's say that we do the campaign, LinkedIn, email, I'm sorry, 8 opportunities are sourced through that. Then we run the same list through LinkedIn. Again, pulling numbers that we got out of our past campaigns. We have a connection rate on LinkedIn around 10%. It means that we connect with 200 owners. Reply rate is quite high on LinkedIn, so we can get 40% reply rates. 80 of people reply out of these 200. If half of them are interested, 40 are gonna, entertain a conversation. Let's say booking rate is the same. 20 book a call, 75 show up. We have 15 booked appointments with people that are interested in selling their business. I'm keeping this part of the funnel untouched for LinkedIn and email. Of course, numbers may change, but again, for simplicity, we're keeping it this way. And again, this figure might be a little bit skewed. Let's say that instead of having a positive reply rate of 50%, we have it at, let's say, 25, something like that, or let's say 30%. Let's say it's 30. Okay, I need to change it here. Okay, so in that case, we will get 9 for LinkedIn as well. Now, let's say that we roll the same list into an SMS process, maybe as a follow-up only. Reply rate at 3%, very conservative. Get 60 replies, positive. We assume it very low because a lot of them are just going to say stop, don't contact me again, because SMS is quite invasive. We get 15 total positive, 50% book a call or say call me since you already have my number, and then 75% pick up or show up for the meeting. So it's total 6. Again, these numbers are kept kind of conservative because in my experience, if people reply positive to an SMS, generally are more likely to get on the call, or at least say call me, because you already have my number anyway. So this number might be higher, 75% or something like that. But again, just trying to keep things conservative, at least in this case. Same thing applies for call. Let's say that once we've done all of this, that can be automated, by the way, we want to do some manual output, kind of like pick up the phone and call people. We run the same list through a call sequence, so we call them directly. We have a pickup rate at 25%, so 500 businesses pick up. 5% of them only reply positively to the opportunity of selling the business. So 25 positive replies, 50% book. Again, same. 13 total bookings, 75% show up. We get 9 here as well. Again, I don't want to make it too long, but same goes for the letter. Letter is a little bit different because we send out letters, so we're just going to get replies from people that are actually interested. So if we assume a 2% reply rate from letter campaigns, we get 40 replies, and people that reply to a letter would generally either call us to the call number that we put into the letter, or schedule an appointment on the link that we put in the letter. So we can assume direct booking rate of 50%, total bookings 20, show up rate 75, total shows 15. Again, these are multi-channel approaches that will deliver less opportunities, but we can still hit the overall outcome, or at least get close to it. 47, as you can see here, is the total opportunity count if we run a multi-channel system. And this is, again, for a very restricted list. And I think that the reason why I want to share this is, one, to discuss the importance of multi-channel outreach for small markets, because again, if you only focus on one, like email, you might be killing your chances of success. But also to emphasize the opportunity that is available to most people that might have a addressable market that is very, very big. I mean, if we say that you have 5,000 businesses and we keep doing the same math, you can see that numbers compound quite fast. So the amount of opportunities that you can get through the door go up as you increase the target market that you have. So with 5,000 businesses, you might be looking at 116 opportunities overall. Again, adjustments need to be made to the model, but this is just an example. And this is all to discuss results and expectations in terms of the process. Most people get disappointed when they don't get results in sourcing deals and closing one deal, and they feel that the process doesn't work for whatever reason, or they're doing something wrong. In most instances, the issues are, one, they either they might not be doing multi-channel outreach, so they're completely focused on one or two channels, so they're killing their chances of success, really. And two, they're not considering the fact that a lot of deals will fall apart, even if they're good ones. And this holds true, by the way, for broker deals as well. I didn't run the statistics or the numbers on brokers or networks because that's not what we do. We source deals off market, but you need to account for that too. So people would say, okay, I would focus on broker deals because they have more chances of closing. Well, not really. The only thing that you get through a broker deal is that you have somebody that has done the work beforehand to list the business. So you have data that ostensibly is more organized, but that again is subject to discussion because it depends on the type of broker that you're working with. They're very good ones that do a very great job, so they help you in the process. Others just prevent you from closing a deal in most instances, because either they send you wrong information, misleading information, and so you might want to consider doing something else. But the point is, even broker deals fail. It's not that the success rate increases simply because you're working with brokers. The only thing that increases is that most people that you're going to be talking with through brokers are ostensibly motivated, because otherwise, why would they list their business? But you can solve for that by having a multi-channel system that originates these opportunities for you. And then, yes, you need to do a little bit more digging, but you have control over the opportunity. On the network side, you have no control over this. So you cannot map anything. You can just assume that somebody's going to send you a deal one day. So having no trackability is really dangerous, in my opinion, because it's really not enabling you to understand how you're going to get to this one deal that you want to get. And again, I'm talking about this because even if you are an advisory firm, or if you are a roll-up company and you want to do more deals, right? You just need to take these numbers and put them on steroids. So for example, let's say that you're an advisory firm and you want to do one deal every quarter. So you want to do 4 deals. It means that you need to initiate at least 20 sales side mandates, which means you need to look at least 200 opportunities. How do we get to 200 opportunities? Well, you probably need to get in touch with 10,000 businesses across multiple channels. Let me see if the math pencils out. Yeah. So you can get 233 opportunities. Out of these 233 people that you talk to, 23 are going to be deals that are worth executing and maybe deals that you initiate. And out of these 23, five or four of them might close, and therefore you're going to hit your desired outcome. But if you don't have a clear system to understand where you're getting your next deals and how you're getting to the bottom of the funnel, how can you expect to ultimately hit your goals? I see a lot of people, advisors, roll-ups, even search funds, that just think that every single deal is going to have a 100% chance of success, but that's not true. And so sometimes they are result oriented based on one of the outcomes that they got recently. Maybe they closed one deal, they got a lucky break, or the deal coincidentally was very good, and therefore they ended up closing the first transaction they had in their hands, and they ultimately feel that that's going to be the case for the second and the third and the fourth. Well, in reality, that's not the case. They might have got lucky for whatever reason, or that might just be a coincidence. The point is, we cannot let that be the way we conduct business and the way we source deals, because otherwise we're just gonna end up being disappointed, frustrated, and we're gonna wonder why after some time we're not closing the amount of deals that we would like to close. And so we need to do the math around how we can get there predictably, and then of course adjust based on the results that we get from the market, because these figures might change depending on how we run our process, how we structure it. Even these assumptions that I made might be completely skewed, right? Maybe in your industry we're talking about one out of two businesses that initiates due diligence ultimately closes. That's good news, but it might be that only one business out of 100 that are available for sale is actually worth buying. So we need to pencil out these figures and make sure we build a system that delivers you the ultimate outcome and the outcome that you're seeking. That is, again, for you to consider, and ultimately to understand that this is a numbers game. Even if you're working with small numbers, you can still get the desired results, provided you diversify your effort. You increase your chances of success by touching owners on multiple channels. Otherwise, it's going to be hard and it's going to take longer. That's also the point. We need to consider time when we factor, all these numbers into the equation. If you're okay investing 3, 4, 5 years, banging the same 1,000 business owners until somebody's ready to exit, sure, you might be successful at it. Ultimately, some of them are going to want to retire. But if you want to have a more predictable system that can deliver results, timely, then you need to look at this from a broader perspective, at least in my opinion. And this, again, is just a breakdown made up with assumptions. Do your own math and then see how you can achieve the desired outcome based on your industry standards, your parameters, your search criteria, and all these sorts of things. So we help people source deals through processes like this. We build it out for them. We either do it for them, or we build the systems that they can then use on their own so that they can go ahead and just source transactions. If you're interested in any of that, check out the link below the video. But this is pretty much it from a analysis standpoint. And yeah, we will talk in the next one.